The goal of the global minimum corporate tax rate is to ensure that multinational corporations can no longer shift their profits to low tax havens. In recent years, the debate over establishing the measure has gained momentum, whereas the concept has implications for countries around the world, including Nigeria. In this video, we will provide an analysis and explanation of the potential implications and considerations for Nigeria in the context of a global minimum corporate tax rate. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Let's begin by understanding Nigeria's current tax landscape and how it might be affected by these global changes. Nigeria currently operates a complex tax system with multiple tax rates and incentives. The corporate tax rate in Nigeria is 30%, with potential additional levies depending on the specific industry and location. Besides corporate income tax, there are taxes on dividends, capital gains, and value-added tax, among others. However, this framework has been subject to criticism due to its complexity and potential for tax avoidance. Global Minimum Corporate Tax Rate Proposal. In July 2021, 136 countries, representing more than 90% of global GDP, agreed to a framework for a global minimum corporate tax rate of at least 15%. This agreement, negotiated through the OECD G20 inclusive framework, aims to address international tax challenges and prevent multinational corporations from shifting profits to low tax jurisdictions. But what does this mean for Nigeria? Firstly, it would impact the country's ability to attract foreign direct investment if companies are no longer able to benefit from lower tax rates in certain jurisdictions. Additionally, Nigeria may experience changes in its tax revenue as a result of multinational corporations being required to pay a minimum level of tax on their global profits. Impact on multinational corporations. For multinational corporations with operations in Nigeria, a global minimum corporate tax rate would lead to changes in their tax planning strategies. Companies may need to reassess their global tax structures and potentially face higher tax liabilities in jurisdictions where they currently benefit from preferential tax rates. As Nigeria evaluates the potential impact of a global minimum corporate tax rate, several considerations come to the forefront. One key consideration is the need to ensure that any changes to the tax landscape do not hinder the country's economic growth and FDI attractiveness. Balancing the goal of preventing tax avoidance with the need to maintain a competitive investment environment is crucial for Nigeria's economic development. Domestic tax reforms. In response to the global momentum towards a minimum corporate tax rate, Nigeria may consider domestic tax reforms to enhance its tax system's effectiveness and attractiveness to foreign investors. This includes streamlining the tax framework, improving compliance and enforcement, and creating a more predictable and stable tax environment for businesses. Collaboration with international partners. Given the interconnected nature of global taxation, Nigeria should consider collaborating with international partners to navigate the potential implications of a global minimum corporate tax rate. Engaging in dialogues with other countries and participating in international forums can help Nigeria advocate for its interests and influence the development of global tax policies. Ensuring competitiveness. Nigeria must strive to maintain its competitiveness within the global business landscape while adhering to international tax standards. This may involve engaging in consultation with stakeholders, including multinational corporations, to understand their concerns and ensure that any tax reforms or adjustments do not unduly burden businesses operating in Nigeria. Impact on small and medium enterprises. While much of the focus has been on multinational corporations, the introduction of a global minimum corporate tax rate may also impact SMEs in Nigeria. So it is important to consider the potential effects on these enterprises, including their tax obligations and competitiveness relative to larger multinational entities. Now, let's examine base erosion and profit shifting (BEPS) and its impact on global tax revenue. Base erosion and profit shifting is a significant concern for the global tax framework, posing challenges to tax fairness and revenue collections. BEPS refers to tax planning strategies used by multinational companies to artificially shift profits from higher tax jurisdictions to lower tax jurisdictions, thereby eroding the tax base of the higher tax jurisdictions. The Organization for Economic Cooperation and Development has been at the forefront of international efforts to combat BEPS. Through its inclusive framework, the OECD aims to develop consensus-based solutions to tackle BEPS and ensure that profits are taxed where economic activities generating the profits are performed. This multilateral approach has garnered support from over 140 countries and jurisdictions, reflecting the urgent need for coordinated international action. Pillar 2 and the global minimum tax rate. Pillar 2 of the OECD Inclusive Framework on BEPS introduced a groundbreaking initiative to establish a global minimum tax rate of 15%. Pillar 2, also known as the Global Anti-Base Erosion Proposal, seeks to address the tax challenges arising from the digitalization and globalization of the economy by establishing a global minimum tax rate. The Pillar 2 targets multinational enterprise with an annual revenue exceeding 750 million euros, highlighting the intent to target large and high revenue multinational enterprises that are able to engage in profit shifting and base erosion strategies. In conclusion, while the global minimum tax aims to create a fairer tax landscape, Nigeria must carefully balance the need for tax fairness with its need to remain a competitive and attractive business environment. By collaborating with international partners and engaging with stakeholders, Nigeria can navigate these changes and continue to grow its economy. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.